still my heart. For today, we are going to talk about my very favorite financial statement, the budget versus actuals analysis. Now, don't get me wrong. Balance sheets, which we talked about in episode 2, they're nice. I mean, who wouldn't want to know how much money is in their HOA reserves, or how much principal their HOA still owes on some outstanding loans? And budgets, which we talked about in episode 1, they also have their place. If all you want to know ahead of time is what your HOA board claims it's going to do with your money over the next year. But the budget versus actuals analysis, it's something you can really sink your teeth into. Now, just a note, for the remainder of this episode, I'm going to refer to the budget versus actuals analysis simply as the analysis, because the full name is just too many words to keep repeating over and over. Well, what's so special about the analysis? First, it lets you see what was actually done with your money. Second, it allows you to compare that with the plan presented in the budget and to see whether there were any significant variances. And finally, if you look at the analysis across several years, you can see whether there are any consistent variances from the budget. Consistent variances may suggest that the board is not learning from experience and that maybe the board needs to take a closer look at what's going on. Now, the information in the analysis is not perfect. It summarizes financial transactions over a 1-year period, so you can't really dive into all the gory details. But still, it's pretty darn good stuff. To put this all slightly differently, for each source of income and for each item of expense, the analysis shows the difference between what was budgeted and what actually happened. For example, in the budget, the board may have planned to spend $10,000 on landscaping over the upcoming year. But by the end of the year, the HOA may have ended up spending $15,000 on landscaping. In this case, the variance between the budget of $10,000 and the actual of $15,000 would be $5,000, which is a fairly hefty percent variance of 50%. Okay, so now let's just dive in. Let's start by looking at the analysis for 2022 to see how Colony Lakes Board presents this financial statement. The first thing to notice is that the analysis is laid out very similarly to the way the budget is laid out. At the top, we see sources of income, and in the remainder, we see individual expense categories, including at the bottom, data on the reserves. Let's make looking at this analysis somewhat easier by removing some of the columns. The first 3 columns show data from the last month of the fiscal year, December 2022. Since we'll be focusing on the year as a whole, let's just remove these 3 columns. The next three columns show the data for the entire year. We'll keep those columns. Finally, the last column repeats the data in this column, so we can remove it. Let's look at the remaining columns of numbers. This column shows the amount of anticipated income or expense in individual categories. These numbers come directly from the budget that was prepared by the board at the end of 2021. For example, here you can see that the board budgeted $14,000 for duplex building maintenance. The column just to the left of this one shows the actual amounts of income received or expenses incurred in 2022. For example, here you can see that the HOA actually spent almost $29,000 on duplex building maintenance. And this final column shows the difference or variance between the budget and the actuals. For income, a positive variance means that more income was received than was expected in the budget, while a negative variance means less income was received. For expenses, a positive variance means that less money was spent than was budgeted, while a negative variance means that more money was spent. For example, here you can see that the variance for duplex building maintenance was almost $15,000 in 2022. Since this variance is negative, duplex building maintenance was far more expensive than budgeted for. This is an astonishing 107% variance. Just as an aside, it would be really helpful if the board included percent variance in the analysis. Okay, now that we understand the basic layout, let me describe the four-step process that I use to interpret the analysis. In step one, I look at the top line entries: total income, total expenses, total replacement fund activity, that's the reserves, net income, and if there's a loan, I look at that too. I ask myself, were these top line actuals about what was expected in the budget? That is, were their variances small? If any of their variances were not small, then it would be worthwhile to take a look in more detail at individual sources of income or individual expense amounts to try to figure out why. In step two, I look at any individual entries that have unusually large variances. I actually look for large percent variances. For example, duplex building maintenance has a variance of $15,000, which works out to a percent variance of 107%. This is large. What is the explanation for this variance? It would be nice to know. In step three, for any large percent variances discovered in the previous step, I look back at previous years' analyses to see whether any of them consistently deviated from the budget. If any large variances occur consistently, then I would try to figure out why. For example, let's pick on duplex building maintenance a little longer and see if its large variance is something that happens year after year. As described for 2022, the budget was $14,000 with a variance of almost $15,000, which is percent variance of 107%. So let's back up to 2021. In that year, the budget was $13,050. Not much different than 2022. And the variance was almost $12,000, which is a percent variance of 92%, still really large. Okay, since this issue extends back 1 year, let's continue back one more year to 2020. In 2020, the budget was $11,250. Once again, not much different from later years. And the variance was almost $16,000, which is a whopping 140% variance. So once again, we find that duplex building maintenance is consistently under budgeted by the board. The total dollar amount for these variances between 2020 and 2022 is about $43,000. With such a sizable amount of overspending, this really requires an explanation. Why does the board consistently underestimate this expense, and how is the money being used? Finally, in step 4, I look at the deposits into and withdrawals from the reserves. Now, for this discussion, I'll display the analysis for 2022. This section, the replacement fund activity section, shows the total deposits and withdrawals over the year for each individual reserve fund. For each of these funds, there are 3 categories of transactions. To explain these categories, let's look at the reserve fund for paving. The entry for the paving reserve in the bottommost category is for deposits. Here you can see that while $25,040 were budgeted to be deposited into the paving fund, somewhat less than $23,000 were actually deposited. This is an 8% shortfall from the budget. As an aside, deposits into all of the reserve funds in 2020 were 8% lower than budgeted, resulting in a total shortfall of over $18,000 for the year into the reserves. These missing deposits probably had to be used to cover significant overages in operating expenses, like the overage in the duplex building maintenance expense that we discussed earlier. This emphasizes the importance of proper budgeting so that you're not left underfunding the reserves. Now, going back to paving. The entry for the paving reserve in the topmost category of transactions is for withdrawals from the reserve that took place during the year. Here, you can see that $8,000 were withdrawn to pay for something. Now, subtracting the withdrawals of $8,000 from the deposits of $22,953 yields a total increase of almost $15,000 into the paving reserve for 2022. That's probably not bad, but since there was an unplanned 8% shortfall in deposits, could have been better. Now, let me finish explaining those 3 categories of transactions. The entry for the paving reserve in the middle category of transactions it's actually not particularly useful for how I use the analysis. You can see that the amount of money in this transaction is exactly equal to the entry in the topmost category that was for withdrawals from the reserve. Now, it's exactly the same, except that the signs are opposite. Since their signs are opposite, when you add this transaction to the one for the withdrawal, their sum is 0. And that is the purpose of this transaction. It's intended to cancel or hide the transaction for the withdrawal. This strategy of displaying the withdrawal and then canceling it out with another transaction allows us to see all the transactions that affect the reserves without that display interfering with the calculation of total expenses at the bottom of the analysis. I hope that's clear. At any rate, that covers how our board presents the budget versus actuals analysis and the steps that I take to interpret such a financial statement. I hope you found this information useful. In closing, take care of yourself. Go outside, check things out, and be happy. Bye for now.